Before we begin, please remember that I am not a licensed financial advisor, mortgage professional, or attorney. This presentation is for informational and educational purposes only and should not be considered financial, legal, or investment advice. The world of mortgages is complex and changes constantly. Always consult with a qualified, licensed professional who can assess your individual financial situation before making any major decisions. Your home is likely the biggest purchase you'll ever make, so do your own thorough research. There is a mistake that costs American homebuyers more money than almost any other. It's not overpaying for the house. It's not skipping the inspection. It's a quiet, seemingly innocent error that happens long before you even make an offer. According to multiple studies, more than half of all buyers, and sometimes as many as 70%, only talk to a single lender. And that single decision, that one phone call, could easily cost you $30,000, $40,000, even $60,000 or more over the life of your loan. Think about that. $60,000. That's a brand new luxury car. It's a college fund. It's a life-changing kitchen renovation. It's a significant chunk of your retirement. And most people are unknowingly lighting that money on fire simply because they don't understand the game they're playing. They don't realize that when it comes to getting a mortgage, there are two completely different doors you can walk through. Behind door number 1 is the mortgage banker. Behind door number 2 is the mortgage broker. And choosing the right door for your specific situation is the single most important financial decision you will make in the entire home buying process. The problem is, nobody ever explains this to you. They throw these terms around like they're interchangeable. Banker, broker, loan officer, specialist. It's a confusing soup of titles designed to make you think they're all the same. They are not the same. In fact, they operate in fundamentally different ways with different loyalties, different toolkits, and access to vastly different options. And by the end of this video, you will be one of the very few homebuyers who understands this critical difference with absolute clarity. You won't just know the textbook definitions. You will understand the strategic advantages and hidden disadvantages of each. You will know the exact questions to ask to expose their limitations. And you will have a simple framework to decide with unshakable confidence which path is the right one for you, your family, and your financial future. This knowledge won't just save you from that $60,000 mistake. It will give you control, it will give you options, and it will dramatically reduce the stress of the biggest purchase of your life. So let's demystify this once and for all. I want you to imagine you're planning a very important dinner. This isn't just a casual Tuesday night. This is a milestone anniversary, a huge celebration. You want the perfect meal. You have two choices for how to find it. Your first choice is to go to that famous, high-end restaurant downtown. Everyone knows its name. You've seen the commercials. It has a beautiful building, an army of staff, and a world-renowned chef. This restaurant represents the mortgage banker. A mortgage banker works for one single financial institution: a retail bank, a credit union, or a direct lender. Think of the big names you know: Chase, Bank of America, Wells Fargo, Rocket Mortgage. They are the restaurant. Their loan officers are the chefs. And here's the crucial part. That chef, no matter how skilled, can only cook with the ingredients they have in their own kitchen. They only have one menu: their bank's menu of loan products. Their recipes are their bank's underwriting guidelines. The prices are their bank's interest rates. Now, if you walk in and you want exactly what's on their menu, let's say their famous steak dinner, which is like a perfect 30-year fixed loan for a borrower with a 780 credit score and 20% down, then you might have a fantastic experience. The chef is an expert at making that one thing. The system is efficient. It's a well-oiled machine. But what happens if you have a dietary restriction? What if you're gluten-free? Or you're a vegetarian? What if you're on a very specific budget? The chef can't just run down the street to another restaurant's kitchen to grab some tofu or gluten-free pasta for you. They can't do it. They'll look at their menu, look at their ingredients, and say, "I'm sorry, all our sauces have flour." Or, "The best we can do is a side salad." They might even try to convince you that their steak is so good, you should just forget about being a vegetarian for one night. They have to sell you what's on their menu because that's all they have. In the mortgage world, this dietary restriction could be anything. Maybe you're self-employed with complex tax returns. Maybe you have a slightly bruised credit score from a medical bill a few years ago. Maybe you're buying a unique property, like a log cabin or a condo in a building with weird rules. The mortgage banker looks at their one set of recipes, their underwriting guidelines, and if you don't fit perfectly into their box, they have two options. Try to cram you into a product that isn't quite right, or simply say, "Sorry, we can't help you." Their loyalty at the end of the day is to their restaurant, their bank. Now let's look at your second choice for that perfect anniversary dinner. Instead of going to one restaurant, you call a personal food concierge. This person doesn't own a kitchen. They don't have a menu. Their entire job, their entire business model, is built on knowing every single restaurant in the city. This is the mortgage broker. A mortgage broker doesn't work for a single bank. They are an independent intermediary. Their job is to work for you, the client. They have established relationships with dozens, sometimes hundreds of different wholesale lenders. These are the restaurants. You have the big five-star steakhouses, which are the giant wholesale lenders. You have the quirky, authentic Italian places that only locals know about. Those are the niche lenders who specialize in certain types of loans. You have the amazing, affordable taco trucks, which are the lenders who are super competitive on price but don't have big marketing budgets. So you tell the food concierge, the broker, what you want. You say, "I'm celebrating my anniversary. I'm gluten-free, my partner is a vegetarian, we love spicy food, and our budget is about $100 per person." The concierge doesn't try to sell you on one specific menu. Instead, they access their entire network. They say, "Okay, I know a fantastic Thai place that has an incredible dedicated gluten-free menu. I also know a new farm-to-table spot that could create a custom menu for you. And there's an upscale Mexican restaurant that has the best reviews in the city for creative vegetarian dishes. Let me check their pricing and availability for you." The broker's loyalty isn't to a single kitchen. It's to finding you the perfect meal. They shop the market on your behalf. They take your single application, your dinner order, and they present it to multiple lenders or restaurants to see who can offer the best combination of product, price, and service for your unique needs. They know which lenders are great for self-employed borrowers, which ones have the most lenient guidelines for credit scores, and which ones are offering the most competitive interest rates on VA loans this week. They are your guide to the entire marketplace, not just a salesperson for one single brand. This is the fundamental difference. One is a seller of a single brand's products. The other is a personal shopper for the entire market. One offers you their solution. The other finds you the best solution from a wide array of options. And understanding which model serves you best is the key. So, let's stop talking in analogies and get into the real world with real dollars and cents. We're going to pull back the curtain and walk directly into the office of a mortgage banker. We're going to examine their world, understand their motivations, their strengths, and their critical weaknesses. We'll look at who they're perfect for, and who should absolutely run in the other direction. Let's start with the biggest players on the field. Let's talk about the mortgage banker. Imagine you're at a massive, brightly lit superstore. A place like Costco or a huge flagship Apple store. It's clean, it's efficient, and everything on the shelves has the same brand name on it. They designed the products, they manufactured them, they packaged them, and now they're selling them to you directly from their own store. You're dealing with the source. That, in a nutshell, is a mortgage banker. A mortgage banker is a direct lender. Think of the big names you already know: Chase, Wells Fargo, Bank of America, or even massive online players like Rocket Mortgage and Loan Depot. These are institutions that use their own funds, or a giant line of credit called a warehouse line, to give you the money for your home loan. They are the factory. They control the entire process from the moment you apply to the moment the keys are in your hand. When you walk into their proverbial store, you are only shopping their products. The loan officer you speak with is an employee of that specific bank or lender. Their job is to sell you one of their company's mortgage products. They will take your application, their in-house processing team will verify your documents, and their in-house underwriter, the ultimate decision maker, will approve or deny your loan based on that specific company's guidelines. They control everything: the people, the money, the rules, and the timeline. This level of control is both their greatest strength and their most profound weakness. Let's break down exactly what that means for you. First, let's talk about the massive advantages. The biggest one: speed and control. Because the loan officer, the processor, and the underwriter all work for the same company, often in the same building, communication can be lightning fast. Your loan officer can literally walk down the hall and talk to the underwriter about your file. There are no third-party companies to coordinate with, no external approvals to wait for. It's a straight line from A to B. In a hot real estate market, this speed can be the single most important factor in getting your offer accepted. Imagine a seller has two identical offers. One is from a buyer using a big, reputable mortgage banker who can promise a 21-day closing. The other is from a buyer whose financing is a bit of a question mark and might take 45 days. Which offer do you think the seller is going to take? The banker's direct control over the timeline is a powerful weapon in a bidding war. The second major advantage is simplicity. It's a one-stop shop. You know exactly who you're dealing with from start to finish. There's a sense of security that comes with a well-known brand. You're not just dealing with Steve's Mortgage Shack. You're dealing with a multi-billion-dollar institution. For many people, especially first-time homebuyers who are already overwhelmed, this simplicity is incredibly appealing. One application, one company, one point of contact. Feels safe and straightforward. And for some people, it gets even better. If you already bank with, say, Chase, you have your checking account, your savings, your credit cards with them, applying for a mortgage there can be a breeze. They already have years of your financial data. They know your income patterns, your spending habits. This can lead to a much smoother application process, and sometimes, even special relationship discounts on your interest rate or closing costs. They want to keep your business under their roof, and they'll often reward you for that loyalty. Finally, some large mortgage bankers, especially portfolio lenders, have unique loan products you can't find anywhere else. A portfolio lender is a bank that plans to keep your loan on its own books for the long haul instead of selling it off. Because they're not selling it, they don't have to follow the standard rules set by Fannie Mae and Freddie Mac. This means they can create their own guidelines for unique situations, maybe a special loan for doctors with a lot of student debt, or a more flexible option for a self-employed person with a complicated but high income. If you happen to fit perfectly into one of their niche product boxes, they could be your only and best option. So to recap the strengths, you get speed, control, simplicity, brand name trust, and potentially special products or relationship discounts. It sounds pretty great, right? Well, this is where we have to turn the coin over and look at the other side. The single biggest weakness of a mortgage banker is the flip side of their greatest strength. Their product selection is a universe of one. They can only offer you their loans with their rates and under their specific rules. It's like walking into a Ford dealership. The salesperson can be the nicest, most knowledgeable person in the world. They can show you a fantastic Ford Explorer that has incredible features, but they will never, ever tell you that the Toyota Highlander across the street is a better fit for your family and is currently on sale for $2,000 less. It's not their job. Their job is to sell you a Ford. A mortgage banker works the same way. They are legally and professionally obligated to sell you their company's products. They might have a great rate, but is it the best rate available on the entire market that day? You have no way of knowing unless you do all the legwork yourself. And that means going to Bank of America and filling out a complete application and getting your credit pulled. Then going to a local credit union and doing the exact same thing. Then going to Rocket Mortgage and doing it all over again. Every single one of these applications typically results in a hard inquiry on your credit report. While the credit bureaus are smart enough to group multiple mortgage inquiries within a short period, it can still be a major hassle and can temporarily ding your score. With a banker, the burden of shopping around is 100% on you. The second major weakness is rigidity. Big institutions run on standardized systems and strict, black and white rules. They have to. It's how they manage risk across millions of loans. They often add their own extra rules called lender overlays on top of the basic national guidelines. This means their credit score requirement might be 20 points higher than the absolute minimum, or they might be extra conservative about your debt-to-income ratio. If your financial situation is even slightly outside of their perfect cookie-cutter mold, you can get a fast and firm no. There's often very little room for nuance or common-sense exceptions. You might be a brilliant entrepreneur whose income has tripled in the last year. But if it doesn't fit neatly into their 2-year average calculation, the computer says no. End of story. You can feel like a cog in a massive, unfeeling machine. Your loan officer might sympathize, but their hands are tied by corporate policy written by someone 1,000 miles away. So, who is the mortgage banker perfect for? First, the simplicity seeker. This is someone with a strong, stable W-2 job, a great credit score, and a standard 20% down payment. They probably already have a relationship with a big bank. Their priority isn't to spend weeks hunting for a rate that's 0.1% lower. Their priority is a smooth, predictable, and easy process with a brand they trust. For them, the convenience is worth more than the potential savings. Second, the speed demon. This is the buyer in a brutally competitive market. They know that the ability to close in 20 days instead of 40 is their golden ticket. They need the certainty and control that a direct lender's in-house process provides. It's a strategic advantage, and they're willing to stick with one lender to get it. And third, the niche borrower. This is that person who happens to be the perfect fit for a bank's unique portfolio loan, the doctor, the lawyer, or the person needing a jumbo loan that only a few big players handle well. For them, the banker isn't just an option. It's the only option. Now, who should probably steer clear? First, the rate maximizer. If your number one goal is to secure the absolute lowest possible interest rate on the market, putting all your eggs in one banker's basket is a terrible strategy. You are leaving money on the table by not exploring the entire universe of lenders. Second, the outside-the-box borrower. This is anyone with a slightly complex or non-traditional financial profile. If you're self-employed, have fluctuating commission income, had a credit hiccup a few years ago, or are trying to get a loan with a low down payment, the rigid guidelines of a big banker are likely to be a frustrating brick wall. You need flexibility, and that's often the last thing a massive institution can offer. So the banker offers an incredible package of speed and simplicity, but it comes at the steep price of limited choice and rigid rules. It's a powerful tool for the right person, but a potential trap for the wrong one. But what if you could get the best of both worlds? What if you could have someone on your side whose entire job was to be the ultimate shopper? Someone who doesn't work for any single lender, but instead has access to dozens of them, and can pit them against each other to fight for your business? Someone who specializes in finding a home for those outside-the-box loans? Well, that brings us to the other major player in this game, the polar opposite of the big box store. Let's talk about the master navigator of the mortgage market. Let's talk about the mortgage broker. Think of a mortgage broker as your personal mortgage shopper. They aren't an employee of a big bank. They don't work for one single institution. In fact, they don't lend any money at all. A mortgage broker is an independent, licensed professional whose entire job is to act as the middleman between you, the borrower, and a wide variety of different lenders. If the mortgage banker is the big box store, the mortgage broker is the expert personal shopper you hire to navigate the entire mall for you. You don't go to the Nike store, then the Adidas store, then the New Balance store trying to find the perfect shoe, filling out paperwork at each one. Instead, you tell your personal shopper, "I'm a runner, I have a slight pronation, I need good arch support, and my budget is $150. That shopper then uses their expert knowledge to go to every single store in the mall, sift through all the options, and come back to you with the 3 best shoes that perfectly match your unique needs. That is precisely what a mortgage broker does for your home loan. The process is fundamentally different. When you go to a mortgage broker, you fill out one single loan application. You provide your documents, your pay stubs, your tax returns, your bank statements one time. Your credit is pulled one time. The broker then takes this complete package, your financial DNA, and they shop it for you. But where do they shop? They have access to something you don't, the wholesale mortgage market. See, many of the big banks and lenders have 2 sides to their business. They have their retail side, which is the mortgage banker we just talked about, serving customers who walk in the door. But they also have a wholesale side. This division doesn't work with the public at all. It only works with licensed mortgage brokers. Their entire business model is built on having brokers bring them qualified, ready-to-go clients. On top of these wholesale divisions of major banks, brokers also have relationships with dozens, sometimes hundreds of other lenders. These are specialized companies you've probably never even heard of. Lenders who focus only on jumbo loans for high-value homes. Lenders who are experts at bank statement loans for self-employed borrowers. Lenders who have more flexible guidelines for people with lower credit scores or unique income situations. The broker takes your single application and submits it to a curated list of these wholesale lenders who they know are a good fit for your profile. And then, something magical happens. The lenders compete for your business. Lender A comes back and says, "We can do this loan at 6.75% with $1,000 in lender fees." Lender B might say, "We can match that 6.75%, but we'll do it with 0 fees." And Lender C, a smaller, more aggressive company, might come in and say, "We can get you a rate of 6.5%. The broker then comes back to you, not with a single take-it-or-leave-it offer, but with a menu of options. They'll lay it all out for you. They'll explain that Lender A is known for closing incredibly fast, Lender B has amazing customer service, and Lender C has the best rate but might require a little more paperwork. They act as your advisor, helping you weigh the pros and cons to make the best possible choice for your situation. So, what are the massive advantages of this model? First and most obviously is choice. And choice creates competition. You are not a captive customer of one bank's daily rate sheet. You are the prize that multiple lenders are fighting over. In almost any market, having companies compete for your business is going to result in a better deal for you, the consumer. This could manifest as a lower interest rate, which could save you tens of thousands of dollars over the life of the loan, or it could mean lower closing costs, saving you thousands of dollars out of pocket on day one. The second huge advantage is convenience. One application, one credit pull, one point of contact. Imagine trying to replicate this process yourself. You'd have to go to Bank of America, then Chase, then a local credit union. You'd fill out 3 separate, lengthy applications. You'd have your credit pulled 3 different times, which can negatively impact your score. You'd be juggling paperwork and requests from 3 different loan officers who all work differently. With a broker, you do the work once and they handle the rest. It simplifies one of the most stressful processes of your life. Third is expertise and access. This is where a great broker really earns their keep. A good broker is a master of the mortgage universe. They know the intricate guidelines of dozens of lenders. They know that Lender X is fantastic for veterans using a VA loan, but Lender Y has a special program for doctors with a lot of student debt. They know that if you're self-employed with complex tax returns that show a lot of write-offs, the big bank will likely deny you. But they know 3 specialty lenders who understand how to analyze your actual cash flow and will approve your loan. They are the navigators who can find a path for those outside-the-box borrowers we talked about earlier. For a broker, those aren't problem files. They're just another day at the office. The fourth advantage is that the broker works for you. Their loyalty isn't to a single bank. It's to getting your loan closed. A mortgage banker is an employee of the bank. Their primary duty is to their employer. A mortgage broker is an independent agent whose success is directly tied to your success. If your loan doesn't close, they don't get paid. This aligns their incentives directly with yours. They become your advocate, your quarterback, fighting on your behalf with the lender's underwriter, solving problems and pushing your file across the finish line. Now you're probably thinking, this sounds great, but how does the broker get paid? There's no such thing as a free lunch. And you're absolutely right. This is a crucial piece of the puzzle. There are 2 primary ways a broker is compensated, and it's all transparent and disclosed to you upfront on your official loan estimate document. The most common method is called lender-paid compensation. In this model, the lender, the one who ultimately wins your business, pays the broker a commission for bringing them a new loan. This payment is built into the interest rate they offer you. So if the lender's raw rate is 6.25%, they might offer it to you through the broker at 6.5%, and that extra quarter-point spread is used to pay the broker's commission. Now, here's the critical part. Federal law, specifically the Loan Originator Compensation Rule, was put in place to protect you. It prohibits brokers from being paid more by one lender than another. This means they can't steer you to lender A just because lender A pays a higher commission. Their compensation is a set percentage regardless of which lender you choose, which rate you get, or what loan terms you agree to. This ensures their advice is unbiased. The second, less common method, is borrower-paid compensation. Here you pay the broker directly. It might be a flat fee or a percentage of the loan amount that you pay as part of your closing costs. In exchange, the broker gives you access to that raw interest rate from the lender, with no commission baked in. Depending on the loan size and the specific deal, this can sometimes save you money. A good broker will present both options to you and help you calculate which one makes more financial sense. So, with access to more loans, the power of competition, expert guidance, and someone who is contractually on your side, it really starts to sound like using a mortgage broker is a no-brainer. It seems like the obvious superior choice for every single homebuyer. So why do mortgage bankers even exist? Why would anyone willingly walk into the big box store and take the one option on the shelf when a personal shopper is waiting to scour the entire market for them? Well, the broker model isn't flawless. There are potential downsides, hidden complexities, and situations where the banker might actually be the safer, smarter bet. The very structure that gives a broker their greatest strength, their independence, can also create their greatest weakness. What happens when the person who is supposed to be your champion has no direct control over the final decision? And what is the one critical part of the process that can bring everything to a screeching halt, leaving you and your dream home in limbo? That critical part of the process, the one that can stop a multi-$100,000 transaction dead in its tracks, isn't a person you will ever meet. You won't speak to them on the phone. You won't exchange emails with them. They are the ghost in the machine, the final boss, the gatekeeper standing between you and the keys to your new home. This person is the underwriter. And the single biggest difference between a mortgage banker and a mortgage broker often comes down to their relationship with this all-powerful figure. Let's be very clear about what an underwriter does. Their job is not to be your friend. Their job is to protect the lender's money. They are the risk assessors. They take the beautiful, organized loan application your loan officer put together, and they treat it like a crime scene. They are looking for clues for inconsistencies for any reason at all, to believe that you might not be able to pay back this massive loan. They verify every single number. They scrutinize every pay stub, every bank statement, every line on your tax return. They question everything. That large deposit from your parents for the down payment? They need a signed gift letter and proof the money came from your parents' account. That new job you just started? They need to verify your employment not just once but probably again right before closing. They are methodical, they are meticulous, and they are the final authority. Your loan officer can plead your case, but the underwriter makes the call. So, how does this play out in the real world when you're working with a mortgage banker? Imagine you've found the perfect home. You're working with a loan officer at a big, reputable bank. Let's call it Mega Bank. Your loan officer, let's call him David, is great. He's been super helpful, he's collected all your documents, and he's submitted your file for approval. Here's what happens next behind the curtain. David packages your file and sends it down a digital hallway to his own company's processing department. The processor double-checks everything, making sure all the I's are dotted. Then, they send it to the next desk in that same digital hallway, the underwriting department. The underwriter who gets your file is also an employee of Mega Bank. She sits in the same virtual building as David. They might even be on the same company-wide Zoom calls. This can be a good thing. The process can feel streamlined, integrated. David can message the underwriter directly through their internal system. There's a certain efficiency to having everyone under one roof. But here is the massive, critical limitation. The underwriter at Mega Bank doesn't just work for Mega Bank. She works by Mega Bank's rules. Every lender has its own specific set of guidelines, its own risk tolerance. They might have rules that are far stricter than the baseline federal requirements. These are called investor overlays. Maybe Mega Bank has an overlay that says they won't lend to anyone with a credit score below 680, even if federal guidelines allow for a lower score. Maybe they have a rule that says a self-employed borrower needs a 3-year history, not just 2. So what happens when the underwriter looks at your file and finds something that violates one of Mega Bank's specific, internal overlays? She denies the loan. Or more likely, she issues something called a conditional approval, which is a long list of demands, the conditions, you must meet before she'll give the final sign-off. And some of these conditions might be impossible to meet. David, your loan officer, is now in a tough spot. He can try to argue your case. He can go to the underwriting manager. But he is arguing with his own colleague, within his own company's rigid structure. If the rule is the rule, his hands are tied. He can't just say, well, you guys are being unreasonable. I'm taking my client's loan somewhere else. He can't. He works for Mega Bank. Your loan and his commission are trapped inside that one single institution. Your only hope is a lengthy, uncertain appeal process, all while the clock is ticking on your purchase contract. Now let's rewind and run the exact same scenario, but this time you're working with a mortgage broker. Let's call her Maria. Maria takes all your same documents. She packages your file in the exact same way. But she doesn't send it down the hall. She has a decision to make. She looks at her computer screen, which shows the programs and guidelines for dozens of different wholesale lenders, dozens of different underwriters. She sees Lender A, a massive national bank. She sees Lender B, a smaller, more nimble non-bank lender. She sees Lender C, a credit union that offers great programs for first-time buyers. She analyzes your specific file. She knows you have a slightly complex income situation because you get a large annual bonus that makes up a big chunk of your pay. She knows that some lenders have very strict rules about how to calculate bonus income. So she bypasses the lenders she knows will cause a problem. She chooses a wholesale lender, let's call them Apex Lending, that she knows from experience is great with bonus income. She submits your file to Apex Lending. The file goes to an underwriter at Apex. This underwriter is not Maria's colleague. They don't work for the same company. Maria is an outside partner. The underwriter at Apex issues a conditional approval just like before. But maybe they ask for something that seems a little unreasonable. Maria gets on the phone with her account executive at Apex, her dedicated representative, and advocates for you. They work through the issue. But let's imagine the worst-case scenario. Let's say the underwriter at Apex Lending is just having a bad day and digs in their heels on a ridiculous condition. Or maybe a new surprise overlay just came down from their management that morning, and your file no longer fits. Are you stuck? Is your dream over? Absolutely not. This is the mortgage broker's superpower. Maria can simply say, "Okay, thank you for your time." She pulls your entire file back from Apex Lending. She then immediately turns around and resubmits it to lender B, the one she had as her backup plan, whose underwriter she knows will understand your bonus income without an issue. You might lose a day or two in the process, but your loan is not dead. It's just on a different path to approval. The banker is locked into one set of guidelines, one underwriter, one single path. The broker has dozens of paths. If one is blocked, they simply pivot to another. This is the ultimate form of risk mitigation for you, the buyer. The broker's ability to shop for an underwriter who fits your specific financial story is arguably the single most valuable service they provide. It's the difference between a frustrating denial and a smooth closing. Think of it like this. The mortgage banker is like a chef at a restaurant with a fixed menu. They can make the dishes on that menu incredibly well. But if you have a food allergy or a dietary restriction that isn't on the menu, they can't help you. They can't just create a new dish, because they only have the ingredients and recipes for their specific menu. The mortgage broker, on the other hand, is like a personal chef who has access to a dozen different specialty grocery stores. They learn about your specific dietary needs first. Then they go to the right store with the right ingredients to create the perfect meal just for you. If one store is out of what they need, they just drive to the next one. The end result is a meal that is perfectly tailored to your needs. This flexibility becomes life or death for a loan when you have anything at all, that is slightly outside the box. Are you self-employed? Recently changed jobs? Have student loans and deferment? Co-signing with a parent? Each of these situations is interpreted differently by different lenders and their underwriters. A deal that is impossible at a big bank might be a slam dunk for a wholesale lender that specializes in exactly your type of scenario. The banker would never know because they only know their own menu. The broker's entire job is to know every menu at every restaurant in town. So the broker's flexibility gets you the approval. But does that flexibility come at a price? We've been so focused on getting a yes that we haven't talked about the most important number of all. The one you'll be paying every single month for the next 30 years. Are the broker's wholesale rates really better? And what is the one hidden fee that can cost you thousands at the closing table if you aren't paying close attention? Let's start with the broker's secret weapon, the wholesale rate. You'll hear this term thrown around a lot. Brokers will tell you they have access to rates that the public can't get. And in a way, they're right. Think of it like this. A mortgage banker is like a brand name store, say Nike. They design, manufacture, and sell their own product, in this case loans, directly to you at a retail price. A mortgage broker, on the other hand, is like a massive outlet mall. They don't create their own product. Instead, they have relationships with dozens of different manufacturers, the wholesale lenders, like UWM, Rocket Pro, or Loan Depot. These wholesale lenders don't deal with the public directly. They operate on a massive scale, and they offer their loans to brokers at a wholesale price, which is typically lower than the retail price you'd get walking into a bank. The broker's job is to take that wholesale rate, add their compensation, and present it to you as a final package. So, is the broker's rate always lower? The answer, frustratingly, is it depends. 9 times out of 10, a good broker with access to a wide network of lenders will be able to find a wholesale rate that beats the standard retail rate offered by a big bank. They can pit lenders against each other to find the absolute lowest base rate for your specific financial profile. However, it's not a guaranteed slam dunk. Mortgage bankers, especially the giant national banks, have a different kind of power. They have immense balance sheets. Sometimes, to hit a quarterly goal or to attract a high-value client, maybe someone who already has millions in assets with their bank, they can offer a stunningly competitive portfolio rate. They aren't selling this loan on the secondary market. They're keeping it in-house. In these situations, they might use the mortgage as a loss leader, offering a rate so low that no broker can touch it, just to win your broader business. So while brokers often have the edge on rate, you should never assume it. The only way to know for sure is to get quotes from both. But the interest rate is only one half of the equation. It's the big flashy number that everyone focuses on, but the other half, the fees, is where thousands of dollars can be won or lost. This is where we need to talk about the single most important document you'll receive when shopping for a loan, the loan estimate. By law, any lender or broker must give you this standardized 3-page form within 3 days of your application. This document is your Rosetta Stone for comparing offers. And the most important section is on page 2, section A, origination charges. This is the lender's and broker's direct compensation. It's what they get paid for doing the loan. With a mortgage banker, this is usually pretty straightforward. You'll likely see one line item, origination fee, often calculated as a percentage of the loan amount, say 1%. On a $400,000 loan, that's a $4,000 fee. Simple enough. With a mortgage broker, it gets a little more complex and you have to know what you're looking at. The broker's compensation can be structured in two primary ways. The first is borrower-paid compensation. This is just like the banker's fee. It's a direct fee you pay to the broker for their service, and it will be clearly listed in Section A of your loan estimate. You pay it at closing. The second, and far more common method, is lender-paid compensation. This is where the magic and the confusion happens. With this option, you, the borrower, pay no direct fee to the broker. Their commission is paid by the wholesale lender who is funding the loan. It sounds like a free service, but let's be very clear. There is no free lunch in the mortgage world. The way the lender pays the broker is by giving you a slightly higher interest rate than the absolute rock-bottom wholesale rate. That tiny bit of extra interest paid by you every month for 30 years is sliced off and sent to the broker as their commission. This is also known as a yield spread premium. Neither method is inherently good or bad. Lender-paid compensation is great if you're short on cash for closing costs, but it means you're paying more over the long haul through a higher interest rate. Borrower-paid compensation means a higher upfront cost, but you'll secure the lowest possible rate, saving you tens of thousands in interest over the life of the loan. A good broker will present you with both options and explain the trade-offs. A great broker will analyze your financial situation and help you decide which path makes the most sense for you. But this brings us to the ultimate shell game in mortgage shopping: discount points. A discount point is a fee you pay directly to the lender at closing in exchange for a lower interest rate. 1 point typically costs 1% of your loan amount. So on that $400,000 loan, 1 point would cost you $4,000 upfront. In exchange, the lender might reduce your rate by, say, 0.25%. This is where comparing offers gets incredibly dangerous if you're not careful. Let's imagine our homebuyer, Sarah. She gets 2 quotes. Big Bank offers her a 6.75% rate with 0 points. Indie Broker offers her a 6.25% rate. Wow, the broker is a clear winner, right? Not so fast. Sarah, being a savvy viewer of this channel, asks for the full loan estimate. She looks at Section A and her jaw drops. The broker's quote includes 2 discount points, costing her $8,000 at the closing table. The bank's quote has 0 points. So which is the better deal? Comes down to a break-even analysis. The broker's lower rate saves Sarah about $120 a month on her payment. But she had to pay $8,000 up front to get that savings. If you divide $8,000 by $120, you get about 67 months or 5.5 years. This means Sarah has to stay in that house for at least 5.5 years just to break even on the cost of those points. If she thinks she might move or refinance before then, paying those points would be like setting an $8,000 pile of cash on fire. The big bank loan, with its higher rate but 0 points, would have been the smarter financial move. You must always compare loans with the same point structure, or do the math to see if paying for points makes sense for your specific timeline. And finally, we come to the one hidden fee I warned you about. It's not always hidden, but it's the one people miss when they're just looking at the big numbers. It's the underwriting fee. Underwriting is the process where the lender verifies all your financial information and officially approves your loan. It's a critical step, and there's a cost associated with it. A mortgage banker usually bundles this cost into their single origination fee. But with a broker, you're dealing with 2 entities, the broker and the separate wholesale lender. So on your loan estimate, you might see a broker fee in Section A, and then right below it, another fee for $400, $800, or even over $1,000 labeled underwriting fee or admin fee. This is the fee being charged by the end lender who is actually funding the loan. It's a legitimate cost. But if you're not paying close attention, you might see a broker advertising no origination fee and think you're getting a great deal, only to find you're being charged a $1,200 underwriting fee instead. It's a different name for a similar cost. The only number that matters is the total at the bottom of Section A. That is the true cost of getting the loan, and that is the number you must use to compare apples to apples. So we've pulled back the curtain on the money. We know that brokers often have access to better rates, but bankers sometimes have knockout punches of their own. We know that fees can be structured in wildly different ways, and that you have to look at the total origination charges on the loan estimate to find the truth. But a mortgage is more than just rates and fees. It's a complex, stressful process with dozens of moving parts. What happens when something goes wrong? When the appraiser comes in low, or the underwriter asks for one more impossible document the day before closing? Who has more control over the process? Who is more likely to get you to the closing table on time? And who is more likely to leave you stranded, with your moving truck packed and your dream home slipping through your fingers? The answer to that question reveals the single biggest operational difference between a banker and a broker, and it's what we're breaking down next. It all comes down to a single powerful 5-letter word: ROL. Who controls the money, who controls the people, and who controls the timeline? The answer to that question is the fundamental divide between the world of the mortgage banker and the world of the mortgage broker. And it's the reason one might offer you rock-solid certainty, while the other offers incredible flexibility. Let's start with the mortgage banker. When you walk into the office of a direct lender, whether it's a massive national bank or a local credit union, you are entering a self-contained universe. Think of it like a vertically integrated manufacturing plant, like Henry Ford's original factory where raw iron ore went in one end and a finished Model T rolled out the other. First, and most importantly, the banker controls the money. They are lending you their institution's own funds, or more accurately, money from a massive line of credit they control. It's their capital on the line. This single fact changes everything. It means they have a vested financial interest in making sure the entire process is as smooth, efficient, and predictable as humanly possible. Second, they control the people. The loan officer you talk to, the loan processor who collects your documents, the underwriter who makes the final decision, and the closer who wires the funds, they all work for the same company. They share the same logo on their paychecks, use the same software, operate under the same management, and follow the exact same set of internal rules, known as overlays. There is one playbook and everyone is on the same page. This creates an assembly line of incredible efficiency. Your loan file isn't being emailed into the void. It's being handed down a physical or digital hallway. When your loan officer submits your file for approval, it goes to a colleague. If the underwriter has a question about your income, they don't send a vague email to an anonymous inbox. They can send a direct message, pick up the phone, or literally walk over to the loan officer's desk and say, "Hey, I need you to clarify this one pay stub." Problems that could take days to resolve in a disconnected system can be solved in minutes. There is a singular unified chain of command. This means accountability. If something goes wrong, there's no finger pointing. You can't blame an outside party because there are no outside parties. The buck stops right there within the walls of that bank. This in-house control is what provides that feeling of security. Because the bank is only selling its own products and underwriting to its own specific set of guidelines, they develop a deep institutional knowledge. They've seen your exact scenario 1,000 times before. They know precisely what their underwriters will accept and what they will reject. This dramatically reduces the chance of a last-minute, catastrophic surprise. They are far less likely to pre-approve you and then pull the rug out from under you a week before closing, because the person who pre-approved you and the person who gives the final sign-off are playing for the same team, using the same rulebook. That is the banker's core value proposition: a controlled, predictable, and accountable process. Now let's step into the world of the mortgage broker. It is a completely different operational model. If the banker is the factory manager, the broker is the master logistics coordinator, the general contractor of your home loan. They don't own the factory, the tools, or the raw materials. Instead, they maintain relationships with dozens of different factories, in this case wholesale lenders, and their job is to find the one factory that can build your specific loan cheaper and better than any other. First, the broker never controls the money. Let me repeat that. A broker does not lend you any money. They are a professional matchmaker. They connect you, the borrower, with the actual lender who will be funding your loan. This is a critical distinction. Second, the people are disconnected. Your broker is your primary guide, and they may have their own team of processors in-house. But the most critical player in the game, the underwriter, the person with the ultimate yes or no power, works for a completely separate company. They work for the wholesale lender. They could be in an office building 1,000 miles away. They have no direct allegiance to your broker. Their sole responsibility is to protect the lender's money. This creates a process that looks less like an assembly line and more like a complex global supply chain. The broker takes your application, which is like the blueprint for a new product. They then package that blueprint and all the raw materials, your pay stubs, bank statements, tax returns, and ship it off to the best fit factory, the wholesale lender. Your file is uploaded into that lender's portal, and it enters their queue. It's now out of the broker's direct control. It's in the hands of the lender's system, waiting to be assigned to one of their underwriters. This is where the communication chain gets longer. If that underwriter in California has a question about a deposit on a bank statement for a borrower in Florida, they don't call you. They don't even call your broker directly. They typically post a note in their online portal or send an email to an account executive, the lender's salesperson who manages the relationship with the broker. That account executive then contacts the broker, who then contacts you. You provide the answer, which then travels all the way back up that same chain. What could have been a 5-minute conversation in the banker's world can become a day-long game of telephone. This is the inherent risk in the broker model. They have influence but not direct control. A great broker has fantastic relationships with their lenders and can push and pull levers to get things done, but they cannot command a lender to prioritize their file. If that wholesale lender gets a sudden flood of refinance applications and their underwriting turn times balloon from 48 hours to 12 days, the broker and their client are simply stuck waiting. There's no internal lever to pull. This is where the stranded with the moving truck scenario is more likely to originate. It's not because brokers are bad, but because the system has more potential points of failure. The broker might interpret a lender's guideline one way, but the lender's underwriter, who has the final say, interprets it another. A lender could literally change their internal rules midstream, after you're already under contract, leaving the broker scrambling. When a deal goes south, it can devolve into a blame game. The broker blames the lender's unreasonable underwriter, and the lender blames the broker for submitting a poorly documented file. And you, the homebuyer, are caught in the crossfire. So it sounds like a slam dunk for the banker, right? Why would anyone risk the uncertainty of the broker model? Well, this entire discussion has been about the process. We haven't talked about the product. The broker willingly takes on this operational complexity for one massive, overriding reason: to gain access to a universe of options that the banker, locked in their single factory, can't even see. A great broker learns to master this complex supply chain. They know which lenders are lightning fast, which ones have underwriters who are experts in self-employed income, and which ones offer niche programs for unique situations. They are the navigators of this complex world, and their expertise is what mitigates the risk. The banker offers a single path, paved, well-lit, and predictable. The broker offers a map to dozens of paths, some of which might be bumpier, but one of which might lead to a destination that is dramatically better for you. The core difference is control. Direct, in-house control versus indirect, relational control. But this operational difference doesn't just impact your peace of mind and the probability of closing on time. It has a profound and often counterintuitive effect on the price of your loan, the interest rate you pay, and the fees you're charged. How can a broker, with all these different companies and communication chains, possibly end up being cheaper? How does the banker's streamlined, efficient factory translate into cost? That all comes down to the hidden economics of the mortgage world, the battle between retail and wholesale pricing. And understanding that battle is the key to saving thousands of dollars on your loan. So let's pull back the curtain on this hidden world of mortgage pricing. The easiest way to understand the difference between retail and wholesale is to stop thinking about mortgages for a second and start thinking about something you buy every day. Let's say sneakers. Imagine you want to buy the latest, hottest pair of Nike running shoes. You have two main options. Option 1. You can go directly to the official Nike flagship store. It's a beautiful, massive store in a prime location. The lights are bright, the music is pumping, the staff are all wearing Nike gear. You find the shoes, you pay the price on the box. Let's say it's $150 and you walk out. That is a retail transaction. You've just bought directly from the manufacturer, in their own branded environment. Now, what's baked into that $150 price tag? A lot more than just the rubber and fabric of the shoe. You're paying for the shoe itself, of course, but you're also paying for the multi-million-dollar lease on that flagship store. You're paying a piece of the salary for every single employee in that store, from the stock boy to the manager. You're paying for the billion-dollar advertising budget that convinced you to want those shoes in the first place, the celebrity endorsements, the Super Bowl commercials. You're paying for the corporate jets, the massive headquarters, and a healthy profit for Nike shareholders. All of that is bundled into the single retail price you pay. This is exactly how a mortgage banker works. A big bank or a direct lender is the Nike store. They have one brand of product, their own. When you walk into their branch or visit their website, you are in their ecosystem. The interest rate and fees they quote you, their retail price, have to cover the cost of all their massive overhead. The brick-and-mortar branches on expensive street corners, the massive marketing campaigns, the salaries of tens of thousands of employees, the complex corporate structure, the shareholder profits. It's all baked into the rate they offer you. You are paying for the brand, the infrastructure, and the convenience of dealing directly with the manufacturer of the loan. Now let's go back to our sneaker analogy. There's another place you can buy those exact same Nike shoes. Your local independent sneaker shop. It's a smaller store, run by a local owner who is an expert on shoes. How do they get their Nikes? They don't make them. They buy them wholesale. They have a relationship with Nike's distribution network, and they buy the shoes at a much lower wholesale price, a price not available to you, the public. Let's say they buy that $150 shoe for $90. They then put that shoe on their shelf and add their own markup to it so they can pay their rent, their staff, and make a living. They might sell it for $140. It's the exact same shoe made in the same factory, but it's $10 cheaper for you. Why? Because that local shop doesn't have the same colossal overhead as the Nike Corporation. They're not paying for Super Bowl ads or a flagship store on Rodeo Drive. Their leaner operation allows them to sell the same product for less. This is the world of the mortgage broker. The broker is the local sneaker shop. They don't make the loan themselves. Instead, they have access to the wholesale divisions of dozens of different lenders. These are the factories that produce the mortgages. Many of these wholesale lenders are massive financial institutions you've never even heard of, because their entire business model is to work behind the scenes, exclusively with brokers. They don't have public-facing branches. They don't spend $1 billion on consumer advertising. Their overhead is a fraction of a giant retail bank. Because their costs are so much lower, they can offer their mortgage products at a deeply discounted wholesale price. A base interest rate that is often significantly lower than what a retail bank can offer to the public. You cannot call these wholesale lenders directly. Their only customers are mortgage brokers. So the broker takes your single loan application and submits it to this entire network of wholesale lenders. Instantly, these giant competing factories are now in a bidding war for your loan. Lender A comes back with a wholesale rate. Lender B tries to beat it. Lender C comes in with a different offer, maybe with lower fees. The broker is essentially creating a competitive auction for your business on a platform you could never access on your own. Now, of course, the broker needs to get paid. This isn't a charity. Their compensation is typically a percentage of the loan amount, and it's added to the wholesale cost of the loan. But here is the absolute key, the secret that can save you tens of thousands of dollars. Even after the broker adds their compensation, the final, all-in price to you is very often still lower than the retail price you would get from a big bank. The starting point, that raw wholesale interest rate, is so much lower that there's enough room for the broker to make a fair commission and for you to still come out way ahead. Let's put some real numbers to this. Let's say you're looking for a $500,000 loan. You walk into Big National Bank where you have your checking account. They're a mortgage banker. After reviewing your file, they offer you their best retail rate. 7% with $4,000 in lender fees. It's a single offer from a single company. Take it or leave it. Then, you talk to an independent mortgage broker. They take your exact same file and submit it to their network of 20 wholesale lenders. The lenders compete. The best offer comes back from a wholesale lender called Apex Lending, a company you've never heard of. Their wholesale rate is 6.5%. The broker's compensation is 1%, or $5,000. The broker presents you with an option. You can have the 6.5% rate and pay the $5,000 fee at closing. Or the lender can give you a slightly higher rate, say 6.75%, and then pay the broker's fee for you, resulting in a no-fee loan. Let's compare. The big bank's retail offer was 7%. The broker, by accessing the wholesale market, got you a rate of 6.75% with comparable fees. A quarter-point difference. It doesn't sound like much, does it? But let's do the math. On a $500,000 loan, that quarter-point difference saves you over $100 every single month. That's $1,250 a year. Over the first 5 years alone, that's over $6,000 that stays in your pocket instead of going to the bank. Over the 30-year life of the loan, it's a staggering $37,000 difference. On the exact same loan for the exact same house. The only difference was how you shopped. One path was retail. The other was wholesale. One was buying from the fancy brand name store. The other was using an expert guide to buy from the factory. This isn't a trick. It's not magic. It is the fundamental economic difference between two business models. The broker's value isn't just in giving you options. It's in giving you access to an entirely different, and often cheaper marketplace. So, if the wholesale pricing is so clearly better, why would anyone ever go to a mortgage banker? Is the broker always the cheaper, better option? The answer is a surprising no. The banker has a secret weapon, a trump card they can play that a broker simply can't match. And that weapon has everything to do with control, speed, and what happens when things go horribly wrong. This control is the banker's entire world. Imagine a finely tuned Swiss watch. Every gear, every spring, every lever is crafted by the same watchmaker, designed to work in perfect harmony within a single self-contained system. That is a mortgage banker. The loan officer who takes your application, the processor who gathers your documents, the underwriter who makes the approval decision, and the closer who wires the funds, they all work for the same company. They walk the same hallways, physically or virtually. They use the same software. They report to the same managers. They are all gears in a single powerful machine. A broker, by contrast, is like a brilliant personal shopper who knows all the best watch stores in Geneva. They can take you to the store with the best price, the one with the most unique design, but they don't work there. When they submit your order, it goes to a different company with a different set of employees, different managers, and a different set of priorities. The communication happens through a customer service portal, through an intermediary account executive. It's a transaction between two separate businesses. Now, why does this matter? In a perfect world, it doesn't. If your loan application is flawless, perfect credit, stable W-2 job, 20% down, no quirks, either path will get you to the finish line. But let me ask you, when was the last time a life-altering financial transaction involving hundreds of thousands of dollars was perfect? Let's play out a scenario that happens every single day in the real world. You're set to close on your dream home in 3 days. The moving truck is booked. You've already mentally placed the furniture. Then you get the call. It's the oh crap call. The underwriter, during their final review, has flagged a large unverified deposit in your bank account from 65 days ago. You remember it, your dad gave you $10,000 in cash to help with the down payment. You deposited it, thought nothing of it, and never got a gift letter because you didn't know you needed one. To the underwriter, that $10,000 could be anything. An undisclosed loan, money from a mattress, anything that isn't documented. And without documentation, it threatens to blow up the entire deal. The underwriter puts your file on hold. The clock is now ticking. If you're with a mortgage broker, here's what happens next. The broker gets an automated notification from the wholesale lender's online portal. Condition added. Source large deposit. They call you, you start panicking. You call your dad. He's on a fishing trip but promises to sign a gift letter and find the bank statement showing the withdrawal as soon as he gets a signal. A few frantic hours later, you have the documents. You send them to your broker. The broker uploads them to the lender's portal. And then you wait. Your file, with its new documents, has just been placed back in the underwriter's queue. But that underwriter, who works for a completely different company in a different state, has 30 other files in their queue that also have problems. Your broker gets on the phone with their account executive at the wholesale lender. Please, can you get Sarah, the underwriter, to look at this? My clients close in 48 hours. The account executive, who is essentially a salesperson, says, I'll shoot her a message, but she's swamped. I'll do my best. Doing their best doesn't stop the clock. You are now a prisoner to another company's workflow, a line item in a stranger's spreadsheet. The stress is immense. Your fate is in the hands of people your broker can't directly talk to. Now let's rewind. Same, oh crap moment, but this time you're with a mortgage banker. The underwriter, let's call him Dave, flags the exact same deposit. But instead of issuing a condition into a faceless system, Dave swivels in his chair and walks 10 feet to the desk of your loan officer. Let's call her Susan. He says, Susan, what's this 10 grand deposit in the Smith file? We close Friday. I need a gift letter and source of funds like yesterday. Susan doesn't have to wait for a notification. She knows instantly. She calls you, explains the situation with calm authority, tells you exactly what she needs. You do the same scramble with your dad on the fishing trip. You get the documents and email them directly to Susan. Susan doesn't upload them to a portal and pray. She attaches them to an email and sends it directly to Dave, the underwriter, with the subject line urgent. Smith file closing Friday. Or better yet, she prints them, walks them back over to his desk and says, Here you go, Dave. Can you clear this now so we can get docs out? Because they are part of the same team with the same goal of closing the loan, Dave can often stop what he's doing, review the documents on the spot, and clear the condition. The problem that could have taken 24 to 48 hours of agonizing waiting in the broker world is solved in 90 minutes. That is the raw, unadulterated power of control. It's the ability to manage chaos, to prioritize, to escalate, to solve problems through human interaction, not just digital cues. When things go wrong, and they often do, the banker's ability to walk down the hall is a superpower that can save your purchase. This control also translates directly into speed. Because the banker's process is a closed loop, it's inherently faster. There are no handoffs between different companies. In a competitive housing market where a seller has multiple offers, being able to confidently promise a 21-day or even a 15-day close can be the single factor that gets your offer accepted. A mortgage banker is often in a much better position to deliver on that promise. But their trump card doesn't end there. There's one more, even more powerful weapon in the banker's arsenal, especially for borrowers who don't fit perfectly into a neat little box. It's called portfolio lending. See, most loans, whether from a banker or a broker's lender, are ultimately sold to giant government-sponsored entities like Fannie Mae or Freddie Mac. To be sold, these loans must meet a very rigid set of guidelines, the infamous box. But what if you're a fantastic borrower who just doesn't fit the box? Maybe you're a self-employed business owner with complex, but perfectly legitimate tax write-offs. Maybe you have a huge amount of assets but non-traditional income. A broker must find a wholesale lender whose box you fit into. If none exists, you're out of luck. A mortgage banker, however, especially a larger bank or a credit union, has another option. They can choose not to sell your loan. They can decide to keep it in-house, on their own books, as part of their own investment portfolio. This is a portfolio loan. And because they aren't selling it, they don't have to follow Fannie Mae's rules. They can create their own rules. They can use common sense. They can look at your file and say, you know what? This person is clearly a good risk. Their situation is just weird. We'll approve it. This gives them a level of flexibility that a broker simply cannot match. It's the ultimate exception, the final ace up their sleeve. So the banker's case is built on a foundation of absolute control. Control over the process, control over the timeline, and, in some cases, control over the very guidelines themselves. It's a compelling argument for certainty and speed in a process filled with uncertainty and delays. We have the broker, the master of choice and competition. We have the banker, the master of control and execution. Seems like an impossible choice between two titans. So which one is right for you? How do you make the final call? The key isn't just in understanding their business models. It's in understanding the person sitting across the desk from you, and knowing the 5 critical questions you must ask them before you ever agree to let them handle the single biggest purchase of your life. And the first question is the one that cuts right through the noise and gets straight to the heart of their competence. You look them in the eye and ask, how many years have you been originating loans, and more importantly, how many loans have you personally closed in the last 12 months? Now, this is a 2-part question for a very strategic reason. The first part, how many years have you been in the business, is about stability and general knowledge. Anyone can survive a year or two, 10, 15, 20 years. That suggests they know how to navigate different market cycles. But here's the trap. Years in the business do not always equal current expertise. I've seen loan officers who have been around for 25 years but are coasting into retirement, closing just a handful of loans a year. They might be out of touch with the latest guidelines, the newest technology, the fastest ways to get things done. That's why the second part of the question is the real power play. How many loans have you closed in the last 12 months? This tells you about their current hustle, their relevance, and their recent hands-on experience. A seasoned pro who has closed 50, 80, or over 100 loans in the past year is in the trenches every single day. They know the current underwriters at the banks they work with. They know the quirks of the new appraisal rules. They're solving problems for people just like you right now. What you're listening for is confidence in specifics. A great answer sounds like this. I've been in the business for 12 years, and it's been a fantastic ride. This past year, my team and I closed 87 loans. It was a busy year, but it means we're constantly seeing different scenarios and are up to date on everything. That's a green flag. A red flag answer sounds vague or defensive. Something like, oh, I've been doing this for a long, long time. We do plenty of loans. Or, we focus on quality, not quantity. While that sounds nice, it's often a deflection. You need both. You want a quality professional who is also actively and successfully practicing their craft. Don't be afraid to press for a real number. Their answer will tell you everything you need to know about their current place in the market. Okay, question number 2. This one is designed to see if you're a square peg and they're a round hole. You ask, what types of borrowers or loan programs do you specialize in? Think of it this way, you wouldn't go to a podiatrist for heart surgery. Both are doctors, but their expertise is worlds apart. The mortgage industry is the exact same. There are loan officers who are absolute wizards with VA loans for veterans. They know the entitlement codes, the funding fee exemptions, the specific appraisal requirements, all by heart. There are others who are masters of the jumbo loan world for high net worth individuals, understanding complex income from stock options and business ownership. And there are those who are passionate about helping first-time home buyers, expertly navigating FHA loans and down payment assistance programs. The goal here is to find a specialist who lives and breathes your specific situation. If you're self-employed with complicated tax returns, you don't want a loan officer whose primary experience is with salaried W-2 borrowers. They might see your file as a headache, a problem to be solved, rather than a puzzle they're excited to piece together. A fantastic answer to this question is specific and tailored to you. That's a great question. While I'm experienced in all loan types, about 60% of my business is working with self-employed borrowers like yourself. I'm very familiar with analyzing K-1s and partnership returns, and I know which lenders view that type of income most favorably. That's music to your ears. A worrisome answer is overly generic. Oh, I do everything. FHA, VA, conventional, jumbo, you name it, I can do it. While they might be a capable generalist, it could also mean they're a master of none. It might mean they don't have the deep, nuanced knowledge that can save your loan when a tricky situation pops up. You want an expert, not just an order taker. This brings us to question number 3, and this might be the most important one for your sanity over the next 30 to 45 days. You need to understand their process. Ask them, can you walk me through your entire loan process from today until the day I get my keys? And specifically, how and how often will you be communicating with me? This question isn't about the technical steps of the mortgage process. It's a test of their organization, their transparency, and their communication philosophy. The number one complaint in the real estate world is a lack of communication. Buyers feel like their application went into a black hole, and they only hear from their loan officer when there's a fire to put out. This question prevents that. A world-class loan officer will light up when you ask this. They'll have a system. They'll say something like, absolutely. First, we'll complete the application together. Then it goes to my processor, who you'll meet via email. She'll order the appraisal and title work. From there, it goes to underwriting. My promise to you is a weekly update every single Friday morning. Even if the update is no update, we're still waiting on the underwriter. You will hear from me, your agent, and my processor, so you're never left wondering what's going on. And of course, if anything urgent comes up, you'll hear from me immediately. That is a professional. They have a plan. They respect your time and your anxiety. The red flag here is a vague, reactive answer. Well, you fill out the application, we'll get some documents from you, and then we'll work on getting it approved. Just call me if you have any questions. That's a recipe for disaster. That's the person who will be impossible to reach, who won't return calls, and who will leave you in the dark until 3 days before closing when they suddenly need a document from 5 years ago. Their answer to this question is a direct preview of the customer service you're about to receive. Now for question number 4, which you'll need to tailor slightly depending on whether you're talking to a broker or a banker. If you're with a mortgage broker, you ask, how many different lenders are in your active network? And what is your strategy for choosing the right one for my specific file? This probes the core value proposition of a broker choice. A broker who only works with 3 or 4 lenders isn't much different from a banker. You want to hear that they have a deep bench of 20, 30, or more wholesale lenders. More importantly, you want to hear their strategy. A great broker will say, I have about 40 lenders I can work with, but for you, based on your credit score and desire for a low down payment, I'm already thinking of lender A, who has the best rates for FHA right now, or lender B, who is known for being more lenient on debt-to-income ratios. We'll compare them side by side. If you're sitting with a mortgage banker, you'll ask, beyond the standard 30-year fixed loan, what other unique or portfolio products does your bank offer that might be a creative solution for my situation? This tests if they're just a one-trick pony pushing the company's favorite product. Many direct lenders have special portfolio loans they keep on their own books, that have more flexible guidelines. A good banker will know these products inside and out. They might say, actually, since you have a large amount of assets but a regular income, Our asset qualifier loan might be a perfect fit. It allows us to use your bank statements instead of tax returns to qualify. That's immense value. A bad answer from either a broker or a banker is one that shows a lack of options or a lack of strategy. Finally, we arrive at question number 5. The master question. The one that separates the salespeople from the true advisors. You lean in and you ask with genuine curiosity, looking at my financial picture right now, what do you see as the single biggest potential challenge to getting my loan approved? And what is our proactive plan to overcome it? This question does something magical. It forces them to stop selling and start analyzing. It compels them to look at you as a unique individual, not just another application. A weak or inexperienced loan officer will get uncomfortable. They'll try to gloss over it. They'll say, "Oh, don't worry, everything looks great. It'll be a piece of cake." That is the most dangerous answer you can receive, because no loan is ever a guaranteed piece of cake. There are always potential bumps. A true professional, a real expert, will welcome this question. They will see it as an invitation to collaborate. They'll pause, think, and give you an honest, thoughtful answer. They'll say, "Okay, thank you for asking that. Your credit score is solid and your income is good. The one thing I'm flagging is that you're a recent college graduate and have only been at your new job for 7 months. Some underwriting guidelines require a longer history. So, our plan is proactive. We're going to get a detailed verification of employment from your HR department, and we're going to include a thoughtful letter of explanation in the initial package to the underwriter, highlighting your degree and the stability of your industry. That way, we address the concern before it even becomes a question." Do you see the difference? One answer sells you a dream. The other gives you a strategy. One leaves you vulnerable to last-minute surprises. The other prepares you for battle and shows you that you have a skilled general fighting by your side. This one question, more than any other, will reveal the true character and competence of the person you're about to entrust with your future. Ask these 5 questions and you won't be choosing between a banker and a broker. You'll be choosing the right human being for the job, and that choice will make all the difference. But even with the right person, there's one final crucial piece of the puzzle you need to understand: the numbers themselves. The actual hard dollar costs hidden inside your loan estimate. Let's pull back the curtain on this document, because the loan estimate is where the sales pitch ends and the reality begins. It's the single most important document you'll receive before closing, and 90% of buyers don't know how to read it properly. But you will. This 3-page form is legally mandated to look the same no matter who gives it to you: a giant national bank, a local credit union, or an independent broker. It's a standardized scorecard. And on this scorecard, there are 2 numbers that everyone fixates on, and one section that almost everyone ignores. That's where the game is won or lost. Everyone looks at the top of page 1, the interest rate. It's the big, bold number. It's the headline. And it's the number lenders use to compete for your attention. But right below it is a number that's arguably more important: the APR, or annual percentage rate. What's the difference? The interest rate is simply the cost of borrowing the money. The APR is the cost of borrowing the money plus most of the fees associated with getting the loan, expressed as an annualized rate. Think of it like this: the interest rate is the sticker price of the car. The APR is the drive-off price, including the financing charges, the dealer fees, and all the little extras. The APR gives you a more holistic view of the loan's true cost. A loan with a lower interest rate but sky-high fees can actually have a higher APR than a loan with a slightly higher rate and minimal fees. So, when comparing 2 offers, the APR is a better, though not perfect, tool for an apples-to-apples comparison. But the real truth, the place where you see exactly how your banker or broker is getting paid, is on page 2 under section Origination Charges. This is the holy grail. This box tells you exactly what the lender is charging you to create, or originate, this loan. This is their profit. You might see a percentage of the loan amount, often called points. 1 point is equal to 1% of your loan amount. So on a $400,000 loan, 1 point is $4,000. These can be discount points, which are fees you pay up front to buy down your interest rate, or they can be origination points, which is just a pure fee for the lender. Alongside points, you might see flat fees listed as application fee, underwriting fee, processing fee, or administrative fee. Now let's apply this to our showdown. You get a loan estimate from a big bank. The interest rate looks fantastic, maybe a 1/4 point lower than another offer. You're thrilled. But then you look at Section A. You see a $1,500 underwriting fee, a $995 processing fee, and a $500 administrative fee. Total lender fees, $2,995. These are the fixed costs of doing business with that bank-specific infrastructure. Their loan officers, processors, and underwriters are all on salary, and this is how the bank covers that overhead and makes its profit. Then, you get a loan estimate from a mortgage broker. They've shopped your application to a dozen different wholesale lenders. They might present you with 2 or 3 options. Option 1 has the same low interest rate as the big bank. But you look at Section A, and it's just one line item. A 1% origination fee, which comes out to $4,000 on your $400,000 loan. So, the bank loan is cheaper, right? Not so fast. The broker then shows you Option 2. This one has an interest rate that's 1/8 of a point higher. You're about to dismiss it, but the broker tells you to look at Section A. It's 0. Blank. How is that possible? Because on this option, the wholesale lender is paying the broker's commission directly on the back end. This is called lender-paid compensation. It's built into the slightly higher interest rate. So now you have a real choice. A bank loan at 6.5% with $3,000 in fees. A broker's loan at 6.5% with $4,000 in fees. Or a broker's loan at 6.625% with 0 fees. Which one is best? The answer depends entirely on you. How long will you be in this house? Let's compare the bank loan to the broker's 0-fee loan. The bank loan saves you 1/8 of a point on your interest rate, which on a $400,000 loan is about $35 a month. But it costs you $3,000 upfront. To figure out your break-even point, you divide the upfront cost by the monthly savings. $3,000 divided by $35 is 85 months. That's just over 7 years. If you plan to live in that house for 10 years, paying the fees to get the lower rate is a brilliant move. You'll save thousands in the long run. But if you think you might move or refinance in 3 to 5 years, taking the slightly higher rate with 0 lender fees is the clear winner. You'll never reach the break-even point, so the upfront cost would have been wasted money. A good broker lays these options out for you. A banker can't. They have one menu, one set of fees, and one set of rates for that day. They can't show you what another lender would offer. Their job is to sell you their product. The broker's job is to help you choose the best product from the entire market. This flexibility is their superpower. And it doesn't stop at Section A. Look at Section C. Services you can shop for. This includes things like title insurance, pest inspection, and survey fees. A common tactic for less scrupulous lenders is to intentionally underestimate these third-party costs to make their overall cash-to-close number on page 1 look artificially low and more attractive. They know these costs will rise later in the process, but by then you're already committed. A trustworthy professional, whether a banker or a broker, will give you a realistic estimate for these services. If one loan estimate shows title fees at $800 and another shows them at $2,500, don't assume the first loan is cheaper. Assume the second loan officer is being more honest and transparent about the true costs in your area. So let's bring it all home. After everything we've covered, the structure, the incentives, the process, the people, and now the numbers, what's the final verdict? It's not that bankers are bad and brokers are good. There are fantastic, ethical, and brilliant loan officers working at big banks. And there are inexperienced or lazy mortgage brokers you should avoid. The title on their business card matters less than their competence and character. But the systems they work within are fundamentally different. The banking system is built for scale and serves the institution first. It offers a streamlined, one-stop-shop experience that can be perfect for someone with a straightforward financial profile who values the stability of a household name. The broker system is built for choice and serves the client first. It offers a customized, market-driven approach that is ideal for anyone who wants to ensure they're seeing every available option, or for buyers with unique circumstances that require a more creative solution. The choice isn't about picking a side. It's about understanding the trade-offs. You trade the perceived simplicity of a single bank for the comprehensive options of the open market. You trade the brand recognition of a national chain for the personalized service of a local expert. Your mission as a homebuyer was to find the best possible loan for your specific situation. To do that, you first had to understand the game. You now know the players, you know the rules, and you know how to read the scorecard. You know that the interest rate is just the headline, but the real story is written in the fees. You know to ask about their process, their communication style, and their access to different loan products. You are no longer a passive customer waiting to be sold a mortgage. You are an informed consumer about to make the biggest financial decision of your life with clarity and confidence. The power was never really with the banker or the broker. It was always with you. You just needed the blueprint to unlock it. The best mortgage doesn't come from a bank, and it doesn't come from a broker. It comes from an educated buyer. And now that's exactly what you are.